Cement on to another important discussion. Finance Minister Nirmala Sitharaman made an interesting proposal in the union budget. The government, she said, is working towards launching a sectoral ETF of some of the central government-owned financial institutions. The move, if successful, will help North Block meet its ambitious 1.05 lakh crore divestment target. The question is, ETFs for divestment is one thing. ETFs for capital raising for the PSU banks is quite another. And then you have the quantum of paper that is hitting the market, presumably because of the rule, if accepted, of the public shareholding moving from 25 to 35%. So does the market have appetite for so much of paper and for products like ETFs, if and when it does hit the bourses? And can the ETF product be used as an instrument for capital raising? Let's find out from Sanjiv Shah, co-founder of iPay, someone who introduced the concept of exchange-traded funds in India. Sanjiv, good having you. Thanks much for joining in. It's been a while. Neeraj here. Good morning. What was your sense, Sanjiv, when you heard of these set of announcements? The recent few ETFs, by and large, have had good acceptance. One can question whether the performance has remained good after that. But by and large, the acceptance has been good. Do you think there is more appetite?
Well, I definitely think so. If you look at the amount of money raised through ETFs in the last, nearly about 4 or 5 years, is nearly close to about 80,000 or 90,000. I don't have the exact numbers, but it's in the ballpark number of 80 or 90,000 crores. So remember, this is the amount of money which has been raised by the government for their divestment in ETFs. Now remember, these are the normal CPSE ETFs. Two ETFs, one is the CPSE ETF, one is the Bharat 22. So it's pretty large number when you think about it. And given that there's an appetite for financial services stocks in India, my belief is that basically this will be a very successful launch if and when it happens.
Do you think that the ETF mechanism can be used as a capital raising instrument, aside of course, that whole divestment thing that the ETFs have been very successful in, being a medium for?
Okay, so let's look at the fact that basically, forget the purpose of why our money is being raised. One is basically, I already have stock and I'm going to sell it, which is basically divestment. The government is holding some stock or anybody else is holding some stock, and they're going into the market and giving the stock to the marketplace in form of an ETF. Now, what the government could be thinking, and I'm not privy to that, is that basically can we come up with an idea wherein the underlying companies actually are coming up with fresh new equity. Now, in reality, if you look at it, it doesn't make a difference. The government is going to put in, say, 70,000 crores this year in the stocks of the so-called banks, and then they could actually sell this exact 70,000 crores to the market through an ETF. So, in terms of the process, it may change, but in reality, to the market, it doesn't make a difference. The ETF still remains an ETF of the banking sector, of the public sector, banking sector, and it will, in my view, still be welcomed.
Interesting. Okay, let me rephrase my question then. There is a divestment target slightly higher than last year, but higher nevertheless, which presumably would be done through ETFs. Then there is this proposal of increasing the minimum public shareholding, albeit over a period of years, and we do not know even if it's accepted, but let's work with an assumption that it is in the realms of possibilities from 25 to 35%. And then if we have an ETF mechanism for capital raising, which effectively means more paper coming in. Put all of this together, Sanjiv. Do you think that the market has appetite for so much paper? And because there is presumably so much paper coming in, would it be a good time to introduce an ETF for capital raising, considering that the divestment route will in all probability go through the ETF mandate any which ways?
So a few questions here. One is basically, is there so much of appetite for basically Indian markets or the international FIIs to invest in equities in India, given that basically you have new issuances by existing companies in the private sector and the public sector, and obviously creation of new demand through the ETFs, whether it's divestment or it's through fresh raising of capital. Now that's a question which is on the short run definitely tough because of the fact that basically you haven't got new avenues for people to invest in. But here's my take. My take is that basically the more we can actually diversify the number of people who are investing equity, either through EPFO, which right now is happening in the ETFs, or basically providing a discount to the larger population and having more and more people coming and invest in equities. Remember, the total number of investors in India, demat accounts, and which could be double in terms of number of people and things like that, is just 4 crores. We are a country of 130 crores. Even if you knock off, 80% of the people who can't invest, you're still talking about nearly about 25 to 30 crore people. Now, I believe that Indians are not partaking in the growth story of India, and the measures taken could help the Indian public to move from debt-related investments into equity-related investments. Once we have that, then I think all the questions of whether the appetite is there or not will take care of itself. One other thing which the government has done is they actually allowed ETFs to be used as ELSS investments. And as you know, typically it's the small investor who gets into ELSS. So if you get new investors coming through, in the short run, undoubtedly tough because all this are medium-term measures. But I think it's the right path to take.
Okay. The other question is what the government is trying to do, and that is to raise, looking at that PSU bank bond ETF, something of that nature. Now,
Right.
what do you think merits and demerits? What are the challenges for such a product?
So, as I know, it's not the PSU banks, but it's the PSUs as such, issuing paper. I think, there are two problems. One is the problem of the bond market itself. You don't have liquidity. So basically, pricing of these bonds become very tough. The only advantage, and this is, the government will have to think about how they structure these papers, is the ability of the underlying companies to issue new debt. Remember, one of the biggest problems which we have in India about debt markets is trading. You don't have liquidity at all. And once the paper is issued, it kind of becomes off the run straight off. Basically doesn't trade at all. Now, if the government has market makers, and it ensures that basically the underlying companies issues new paper when new demand comes in. I think this is the way to basically develop the bond markets, one of the measures to develop the bond market. But if they don't do any of this, then I think we may see this particular debt ETF issuance not succeed as much as we all would like to.
Okay. My final question, and since when we've spoken about the bond product, the equity product, now, how easy or difficult do you think it is to get together for the purpose of a PSU bank ETF, if indeed such a product is in the realms of consideration, how easy it is to get 8, 10, 12 PSU bankers together on the table, ensure that the weights, if such a product comes about, is not too skewed, and still make sure that the product is attractive enough, one, to get people in to invest, and two, for the product to do well?
Okay, so in terms of, is it in the offing? It is, because as far as I know, the government has actually issued an RFP for advisors to a bank stroke financial services ETF. So it's a matter of time before it comes. Number two, your second question was, basically, will the bankers come together? That's something, given that, government is a major shareholder, I don't see that as a problem. Because the banks themselves need equity capital, and I don't see a good reason why they won't, basically be receptive to this idea. And given the success of ETFs for divestment and for other purposes, I don't see a problem in that. Now, in terms of performance, look, that's a $1 million question, how it will perform. And
Sanjiv,
given that, you have more liquidity in the market, we'll see what happens.
I get it. No. So very quickly, last 1 minute, what I meant to maybe ask was that if indeed it's a PSU bank ETF with State Bank of India out there, then the weights are very skewed. Is it possible to have a PSU bank ETF ex-State Bank of India?
Yeah, that's a very fair question. But you know what they've done in the CPS ETF? They've capped each one company to a total of 25%. So no company can have a weightage of more than 25%. You can structure the ETF accordingly. So one or two companies don't skew the index. That I think can be done, and I think and should be done. So I wouldn't be worried too much about that problem, because that's something you already have solutions to.